I think that it's probably better to just observe a few things. One is Bitcoin has now been around for 15 years, and there has not been a Bitcoin 2.0. So there's no crypto 2.0. This is Bitcoin is the surviving chain. And Bitcoin has become a $2 trillion asset, which never in history, financial history, has anything reached $2 trillion and then disappeared. So we're not, it's a different argument if it was $100 billion.
Okay.
The third is the U.S. government is reiterated its commitment to make Bitcoin a strategic reserve asset. That's not bad for the price of Bitcoin. So if someone is watching this and said, well, they don't understand Bitcoin, so they decide not to own it, it's a catastrophic way to look at market.
Tom Lee, the visionary financial analyst and co-founder of Fundstrat Global Advisors, has just made a statement about Bitcoin that cannot be ignored. His words carry undeniable weight. No asset that has ever reached the $2 trillion mark has ever vanished. Let that sink in. In a world where trends come and go, Bitcoin stands strong as a symbol of endurance, carving out its place in financial history with the kind of staying power most traditional assets can only dream of. But here's where it gets even more astonishing. The U.S. government has officially recognized Bitcoin as a strategic reserve asset. When the world's most powerful institutions begin treating Bitcoin as a foundational pillar of the financial ecosystem, you know it's something monumental. What we're witnessing is nothing less than a revolution. Governments and global institutions are no longer on the sidelines. They're aligning themselves with Bitcoin's disruptive power. This isn't just another fleeting tech trend, it's the dawn of a new financial era where decentralization, transparency, and digital sovereignty take center stage.
Hi guys, hope to see you guys at Dubai Token 2049. We have exclusive 10% off the limited super early bird tickets. Click the link below. This pass will grant you access to speaking sessions, networking app, exhibition hall, daily networking drinks, and also included breakfast, lunch, and coffee breaks, all included the package. I love to see everyone there. Peace out.
Foremost, when we think about markets in any period of time, we take into account what we generally think is the economic outlook.
Okay.
And one thing I think people miss, and those who are bearish, is that companies have been far more resilient than people expected.
Particularly in the U.S., I guess, right?
Yeah, especially in the U.S. Because in the last 4 years, we had a pandemic that shut down the economy. Then we had a big supply chain shock that created a big inflation wave. Then we had the Federal Reserve raise interest rates at the fastest pace in history. And then we had a very controversial election. Yet in these 4 years, companies produced really good profits. So I think we generally look at what we expect the economy to do, and it's been strong. And there isn't a lot of leverage. But then we also realize that U.S. companies have proven to be very strong. So that's our first part of the process. So I think what really helped us the last 2 years was our bet that inflation was going to be a lot softer than consensus. And that kept us...
I know you've been quite aggressive in predicting inflation is going to be under control, right?
Yes. And, you know, looking back, that was the right call.
Okay.
Because the Fed has been cutting rates now. And in the face of many people who thought the Fed had to create a recession. I think the second part of our work is really thinking about what are the important drivers of sort of surprise. We call these thematic models. You know, one that we'd been talking about for a long time was the global labor shortage since 2018. And we thought that would drive a wave of AI spending. And that's because this global labor shortage happened twice in history, 1947 to 1954 and 1991 to 1999.
I didn't know after World War II there was a shortage.
Yes, well, in World War II, the shortage was because of the mortality from all the fighting. There was a global labor shortage of prime age workers. Both times technology stocks outperformed. So this cycle we predict or forecast will last through 2035. So that's why we're bullish on technology. Another theme that we spend a lot of time thinking about is what we call impact of generations, and it's really the millennial. They're both the largest generation in the U.S. in history, but also set to become the wealthiest because
Okay.
of wealth transfer. And so we spend a lot of time modeling that impact on the economy.
Okay.
And then, of course, the third is really what I'd call digital transformation and security, energy security. And that led us to Bitcoin pretty early.
Okay.
We've been writing about Bitcoin for the last
I know.
8 years.
Yeah, yeah.
So that helps us determine what kind of stocks we are looking for.
Okay.
AI, is a coming wave, and that's because it's a quantum improvement in the capability of a workforce, right? Over time, generative AI is going to produce a PhD level worker, and at an unknown cost today, but presumably with a drastic drop in cost, it'll be cheaper than hiring a human PhD.
Sure. Yeah.
So it's a huge force multiplier. Along the way, I'm sure 90% of the capital will be wasted. But that happened during the internet build out,
that's
and it
true,
happened
yeah.
in the wireless build out.
yeah.
A lot of money was wasted. A lot of promising technologies basically fell flat. So kind of expect that to happen. So it's safe to be betting on what they call the arms merchants right now.
Okay. What do you think is the best way to play the long-term AI theme? Is there an ETF or any group of stocks that you would recommend?
The market's pretty good at figuring this out. So I would say the Mag 7 are all in what I call a primary position to benefit.
Yeah, that's true. Yeah.
And we know that NVIDIA is got a vast lead over others. And we also know that there's going to be critical shortages of power and components. And so these aren't necessarily the best quality companies, but they're the ones that can deliver power and components quickly. So I think that that's the correct way to play this right now. But over time, the real winner are going to be companies that can drastically change their business models because of AI.
Let's talk a little bit about the market. So if we look back this year, I think you made a pretty good call. In your view, what has worked very well and what were some unexpected surprise?
Well, in 2024, I think the principal difference in our view versus the street was that we believed we were only in the second year of a recovery.
Okay.
So the Fed and their tightening cycle essentially created a rolling recession. There was clearly a recession in housing and durable goods and auto sales. In any past cycle, that is a deep recession. And now the Fed is easing. So 2024, in our view, was really the second year of an expansion.
Okay.
Many people instead thought 2023 was the market getting ahead of itself and 2024 would be payback.
Okay.
But instead, we're doing even better this year. I don't think most investors still have accepted that, because when I hear folks talk about the economy, they think we're late cycle. Well, it's been a very expensive late cycle for people, I think it's a disconnection from what people can really observe. If someone talked to their neighbors the last few years, people have been cautious. That's usually not late cycle behavior.
Okay.
Companies have been cautious. The ISM has been depressed for 3 years.
Yeah. Yeah.
That's not late cycle.
Okay.
So as these indicators turn, actually, the economy could actually accelerate.
Tom Lee highlights the resilience of U.S. companies that have not only survived but thrived through the pandemic, inflationary pressures, and rapid interest rate hikes, all while delivering strong profits. He underscores the transformative potential of AI, predicting it will revolutionize workforces and investment opportunities, with leaders like NVIDIA paving the way. Lee also emphasizes the growing influence of millennials, the wealthiest generation, and the rise of digital transformation. Contrary to the view that we're at the tail end of the cycle, he believes the U.S. economy is poised for further acceleration. Focusing on the ongoing momentum in the S&P 500 and Bitcoin, Lee highlights optimism despite cautious market sentiment. For the S&P 500, he forecasts a rise to 7,000 by mid-next year, driven by a pro-business administration, a dovish Fed, and abundant cash reserves on the sidelines. He acknowledges historical trends indicating potential slowdowns in the second half, but stresses the need for flexibility in market assumptions. Regarding Bitcoin, Lee emphasizes its resilience as a $2 trillion asset, its growing strategic importance, and the missed opportunities for those delaying investments until they fully understand it. Let's watch more clips from the interview.
The S&P right now is around 6,000. And we think it's going to go to 7,000 by the middle of next year.
Okay, so by the middle of next year.
Yeah. And at the moment, it could change. But at the moment, we think the first half will be better than the second half.
So stronger first half and
Yeah. And so the market could run out of steam in the second half.
Okay.
So consolidate. And so we end at 6,600.
Okay.
It's still 10% growth for the index.
Okay.
But
After 30% rally, that's pretty impressive, right?
yes. But I think that that's maybe not as important as people to understand that what we're really saying is that after 2 years of 20% gains, the market probably gains again. Because most people think, well, if 2023 was so good and 2024 was so good, we can't have a good 2025.
Yeah. What are the key assumptions in your model predicting nice rally, continuation of the appreciation in the first half and some consolidation in the second half?
Yeah. Well, I think what we have to be mindful of is this is a framework. And I think too many investors think that this is a hard prediction. You know, like I don't think on June 30th, 7,000, like we'll set the clock to that number.
Yeah.
And I think any discussion we have has to be aware that this is just a framework.
Yeah.
But what we're really saying is that there are probably room for more positive surprises in the first half because we have an incoming president that's very pro-business, probably the most pro-business president in modern times. And with so far the cabinet selections that the market is very happy with. So that should be providing room for investors to become optimistic, which they call animal spirits. And the second tailwind is the Fed is dovish, and what that means is the central bank is easing. So that's positive for stocks.
Okay.
The third is investors are cautious because almost everyone we talk to, including you, think that valuations are expensive, or because we've had 2 good years, next year has to be bad. So we know sentiment is cautious. Usually when people are cautious, then you bet against the caution. And then the fourth is that we know mechanically there's a lot of cash on the sidelines.
Okay.
There's a lot of firepower. 7 trillion of cash on the sidelines. So I would see this as positive for the first half of next year.
Okay.
But it could be, maybe the S&P goes up to 7,500, right?
Okay.
I mean, I don't know. 7,000 is sort of just a guess.
Yeah.
The second half, it's more just looking at precedents because since 1870, there have been 5 previous instances where the major index had 2 years of 20% or more gains in a row.
Okay.
And 5 of the 5 times, the market did poorly in the second half.
Okay.
So we might make the gains in the first half. However, that is just history, so we could do a lot better than that. The bond market is pricing in 3 cuts next year. So they're expecting the Fed to make 75 basis points worth of interest rate reductions. Now, the current Fed funds is 4.75%. And neutral, let's say, is 2.75. So that's actually 2 percentage points of easing the Fed has to do, which is about 8 cuts. The question that markets have to deal with is how many of those 8 cuts happen in 2025? So they expect 3, which leaves 5 left for the rest of the easing cycle. I think the best case is the Fed to only do 1 cut next year.
Okay.
Because that leaves 7 cuts in the future.
Okay.
Which gives them a lot of firepower.
Okay.
So I would prefer, but it's not a prediction, to see the Fed pause, and the market might initially get worried, but then they'll realize it's quite bullish. I think that it's probably better to just observe a few things. One is Bitcoin has now been around for 15 years, and there has not been a Bitcoin 2.0. So there's no Crypto 2.0. Bitcoin is the surviving chain. And Bitcoin has become a $2 trillion asset, which never in history, financial history, has anything reached $2 trillion and then disappeared. So we're not, it's a different argument if it was $100 billion.
Okay.
The third is the U.S. government is reiterated its commitment to make Bitcoin a strategic reserve asset. That's not bad for the price of Bitcoin. So if someone is watching this and said, well, they don't understand Bitcoin, so they decide not to own it, it's a catastrophic way to look at markets, because we recommended Bitcoin originally when it was around 1,000, and we recommended investors put 2%, and many people said they won't buy it until they understand it, and then we'd spend 2 years explaining to our clients why they should own some Bitcoin, and they still refuse to buy it. So I don't think, if someone is not going to buy Bitcoin until they understand it, they may end up missing one of the biggest opportunities.
The global cryptocurrency landscape is rapidly evolving, with Bitcoin leading these transformative changes. Recent developments, including Donald Trump's pro-Bitcoin stance, have amplified discussions around Bitcoin mining potentially becoming an exclusively American venture. The U.S. already leads in mining hash rate at 40%, but the push for a complete transition faces challenges such as infrastructure limitations and energy costs. Despite these hurdles, Trump's administration promises favorable policies, fostering optimism within the industry and pushing Bitcoin's price toward a historic milestone near $100,000. Tom Lee emphasizes the significance of these shifts, drawing comparisons to broader economic trends that are driving market optimism. He highlights the resilience of the crypto market and its potential to overcome skepticism, aligning Bitcoin's role in decentralization with global trends like AI and technology-driven economic models. As Lee points out, cautious sentiment often creates opportunities for those who look beyond immediate challenges. The ongoing evolution of Bitcoin mining in the U.S., coupled with institutional support and technological advancements, demonstrates how strategic foresight and policy alignment can unlock significant value. This dynamic interplay of policy innovation and market momentum reflects Lee's optimistic yet adaptable forecasting. Bitcoin's growth narrative, intertwined with national strategies and global economic considerations, is not just about price, it's about redefining value, resilience, and opportunity in an ever-changing financial ecosystem. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.